she wanted to talk about 1031 exchanges and capital gains, which are two fantastic topics which kind of intermingle here.
Before you can really jump into what the 1031 exchange looks like, you've got to understand what capital gains are and how certain people can avoid capital gains as a matter of course. And then you kind of layer in the 1031s. A lot of folks that are selling real estate never really have to worry about capital gains because they're selling a primary residence, right? And we know that the federal government has an exclusion for the sale of primary residence, which says if you lived at the property for 2 out of the past 5 years, you haven't sold any other primary residence in the past 2 years, and you didn't use any portion of the property for rental purposes, then you do not have to actually worry about capital gains. In fact, there's a reporting threshold that might make it even easier to avoid. So the threshold is $500,000 as a married couple, $250,000 as a single person. So that, I think, is probably the biggest tax saving provision that we have on a federal level.
Best one out there.
So then there's a question, well, what happens if the sales price is over those allowable thresholds, right? What if I'm selling as an individual, but my sales price is $300,000? Mm-hmm. Well, now all that's done is triggered the reporting. It doesn't mean there's actually going to be a taxable event. It means that we now have to tell the federal government, and now you need to understand what your gain is. Now, gain is not going to factor in your mortgage. You need to figure out what your basis is in the property. Basis is a term of art that's used on a tax level. So for real estate, your basis is what did you pay for it? What kind of improvements, capital improvements have you put into it? And did you depreciate it? And the issue for capital gains becomes when you don't have a basis in the property or your basis is very low. And that could happen, for example, if perhaps you've inherited the property from a family member. Then you get what's known as a transfer of their basis.
When and where would step up in basis occur?
Step up in basis is a great question. And one that we do get to use is when somebody inherits the property. So if the property has actually been owned at the time of death and then transferred either through a trust conveyance or a probate conveyance, you get what's known as step up in basis, which is fair market value. As of the date of death of the owner, whatever the property is worth becomes the basis for the respective heirs. So that obviously circumvents and precludes all this tax liability.
Melissa, we are now going into 1031 exchanges, which covers investors and protects them from some taxable income, actually kind of kicks the can down the road. Can you explain a 1031 exchange?
So Emilio, just like we were talking about, if you're selling a piece of real estate that wasn't your primary residence or was basically anything other than a primary residence, if you didn't technically use it as a primary residence, it's an other, it's an investment for you. So now you are subject to capital gains. They have to get reported to the federal government. The IRS is going to take their pound of flesh at the end of that taxable year. But if you know that you are planning to reinvest that in money from the property that you have here, all you have to do is hire what's known as a 1031 intermediary. That company or person is licensed with the IRS to take possession of the proceeds from the sale of that initial investment. They hold it in a special account for you so that you can reinvest that money in what's known as a replacement property, as long as you identify the replacement property within 45 days of the closing of the initial property sale and close within 180 days of the initial property. You're good to go. That means, like you said, you kick the can. What's going to happen is that $300,000 is essentially just reinvested, and there's not going to be any capital gains at that time of the sale of the initial property. Just because you are trying to avoid the tax and defer the tax liability now doesn't mean that you will face a tax liability at some point in the future if this property is something you hold on to.